YieldMax just debuted their new YMAX ETF, and this one isn't like the others. Is it a good buy? Let's dive in. This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. YMAX is an ETF of ETFs. It buys all of the 18 YieldMax ETFs, and it rebalances monthly to include any new ETFs in the YieldMax roster. According to the prospectus, they attempt to keep an even allocation of all YieldMax ETFs. If a new ETF is added to their list after that new ETF pays its first dividend, they will rebalance that next month to allocate for the new one. This does mean you could miss out on some capital appreciation in the meantime, but if it goes down before the first payout, you might get more exposure for cheaper. This ETF also employs their own version of a tax loss harvesting strategy. For those who don't know what tax loss harvesting is, it means that you can sell a stock that's already down from your cost basis, then buy back in after the wash sale period. Now, the wash sale period is the amount of time the IRS says you have to wait before buying back in for your loss to be considered deductible on your taxes. In this ETF, when YMAX notices that one of its underlying ETFs is showing a significant unrealized loss, meaning they're holding it for less than they bought it for, they may elect to sell those shares and take that loss on their taxes. However, because of the wash sale rule, they have to do something with that cash in the meantime while they wait out that wash sale period. What they will do in this ETF is replicate the exact same strategy against the same reference stock that ETF was going to do. For example, if they were going to do this against APLY and take a loss on that particular ETF, APLY trades against Apple, they would then trade options against Apple shares the same way that APLY does. The expense ratio on this ETF is a total of 1.28%, but this also does account for being charged on all the underlying ETFs, at least according to the prospectus. The underlying ETFs each charge 0.99%. The rest of it is added on at the YMAX level as an additional management fee, so you are effectively being double charged. Now that we've covered how this ETF works, let's go over the pros and cons. Pros, it's simple, and you own exposure to every ETF on the list. For those who don't really want to have to fiddle around with their own rebalancing, the ETF will handle it for them. As far as I'm concerned, those are pretty much the only pros. Here are the cons. The first, and in my opinion, the worst one, while you do own exposure to all the ETFs that perform well on their list, you also own an equal exposure to the ones that perform poorly, and you have zero control over the allocation and rebalancing of those proportions. And while this may allow you to catch the accidental big gains from something like CONY that had a very good Q4 last year, you'll also absorb all of the really big losses from some of the lower performers. And finally, what I'd consider their cherry on top of this cons list is their tax loss harvesting strategy. While their tax loss harvesting strategy does seem like it would work, I would have rather they added language to allow for the harvesting of capital gains as well. Considering they'd only sell to rebalance or harvest losses, this sounds like they're just increasing the likelihood of investors losing money rather than making as much profit as possible. Would you buy this ETF? Let me know in the comment section below. If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.